Welcome back to Season 4 of Multifamily Unpacked. Today, Funnel's CEO Tyler is joined by the multifamily industry's favorite economist, Jay Parsons. They get right into the latest news, what last week's Fed rate cut actually means, and why rent growth, not interest rate headlines, is what really moves valuations. They also tackle a few hot buttons: fee transparency and the shift to all-in pricing, the reality of city-by-city compliance that operators are struggling with today, and the latest rent control push in New York. And yes, they also talk concessions, why they're everywhere, and why you shouldn't underwrite a magical burn-off next year. All right, here's Tyler's conversation with Jay.
Jay, welcome into Multifamily Impact. This is a thrill for us, an honor, and super excited to dive into the conversation today.
Yeah, thanks for having me, Tyler. I'm excited to talk.
Perfect. All right. So you and I this week were in New York City. Got to see you there. It was super exciting. We were both attending the Pretium Symposium, which was fantastic. And so there's two topics that we're going to start with the top of our docket that are top of headlines across the country. So the big one, right when you arrived in New York and I was headed out, former Secretary Janet Yellen came in and was speaking. But the headlines nationally, internationally were rate cuts. And so obviously that has been the thing that the industry, the world, but especially multifamily has been paying attention to. It's what a lot of folks have pointed to for the slowdown in activity, slowdown in housing starts, as we're aware. So I guess let's just start there with, what did you hear? What are you hearing in the markets? Was the market already basically baking in this rent cut? Or what do we think this means for the industry at large?
Yeah, it's definitely a hot topic. Everyone's looking at their phones at, I think it was 1 p.m. or 2 p.m., whenever it was, that the announcement came out, and everybody just started chatting. And then Willie Walker's on stage. He's trying to tell everybody what happened. So there's a lot of curiosity for good reason. I think you're right, Tyler. I think a lot of people in our industry we're assuming rate cuts would have already happened. And so I think a lot of that has been priced into some of the deals we've seen. So I don't think another 25 bips really moves the needle. I think what's maybe more impactful is the Fed signaling another 50 bips of cuts to come. That would move the needle. I think the caution point, though, is that, and you still won't see the floodgates open yet, is because the Fed has proven to be very bad at forecasting its own future decisions, unfortunately. And I'm not trying to throw shade on them. It's a hard job. I get it. But so I don't think this really changes much. It's a good signal. But a couple other things I'd remind people of is, number one, in multifamily commercial real estate, we're more tied to the 10-year Treasury in terms of how most debt is priced than to the federal funds rate. And the 10-year Treasury is noisy, like the stock market. It actually went up, and hopefully we see it come back down in correlation with the federal funds rate, but that didn't happen on day one. And then the second thing I would say is that I think even barring some sort of drastic rate cut, the more impactful needle mover at this point is seeing a recovery in rent growth. Tyler, it's been 2+ years of, at least nationally, very soft to flat rent growth, in some cases negative in some markets. And that makes our industry valuations based on NOI. NOI is heavily dependent on rent. And so I think until we see some recovery there, it's a 25, 50 bips cut is probably not going to move the needle very much.
Yeah, it's a really great takeaway from this. And Jay, part of the reason we're so excited to have you on the show, I like to joke with you that for the asset managers of the world, like my dad, you're a celebrity. And so I think you often are the voice of the asset manager. And for a long time, it presented the data in our industry in a really insightful way. So if maybe the takeaway here, as you're saying, is the rate cut was a little bit baked in and of itself, it probably doesn't change the outlook for the industry. You just talked about rent growth. And I certainly can agree that our customers, we get to work with some of the largest operators in the country. It just feels like it's always a quarter or 2 quarters away, and we just haven't gotten there. As you mentioned, the reason that Chairman Powell referenced, hey, we're taking the steps to reduce rates, we've got more cuts coming, was tied to the labor market. And so what are the factors that make operators today optimistic for rent growth coming back? I don't think anybody's forecasting in the short term we're going to get back to the 20% rent growth we were seeing in 2021. But is it as simple as, look, because of the lack of starts over the last couple of years, inherently we just believe that the conventional wisdom I hear, but then I certainly worry, as somebody who's a part of the industry, that there's other things afoot, like the labor market softening.
Yeah, that's obviously the multi-trillion-dollar question. I think in terms of optimism, I think number one is demand's still been very good, at least on a macro level. The absorption numbers, 2025, I know like people like to argue about different data sources and whatnot, but you look at any of the big major data sources, 2025 is going to likely end up, barring a drastic shift in these last few months, it'll end up as one of the top years on record for the last 25 years for net absorption. Now, of course, the challenge is we get more into this later, I'm sure, but all that demand is being spread out among more properties because there's so much supply, as you alluded to. But starts have plummeted these last 2 years. This is we peaked on supply last year. We have a lot of supply completing this year. But by the time we get in 26, they'll be below average supply. It'll be back probably to the lowest level since the early years coming out of the Great Financial Crisis, 2013, 2014 timeframe. And that changes the story. And so I think a couple of things. Number one, if the economy holds up, and obviously that's a big if, I think there's good reason to be optimistic. The demand is obviously there. I don't think we're going to immediately change the story around home affordability, which makes apartments a little bit and single-family rentals more sticky for at least the near term. And then the demographic drivers are still in place. And wage growth has still been good despite some of the reported softness in the labor market of late. And it's been disproportionately good among the younger adults who tend to be renting apartments. And so I think there's a lot of things to like. Now, obviously, again, there's two paths here. Number one is what we're seeing in the labor market. Is it some normalization because unemployment has been so low for so long? Are we just getting back to some normal issues, normal range there? Is it being impacted by immigration policy, so therefore more isolated? There's maybe nervousness around tariffs that may or may not play out the way people fear. I think some of that has to be, hate to give the typical economist answer, it depends, but we just don't know. I'm still, I think, relatively bullish. I think we're going to end up more toward kind of normalizing growth as opposed to a significant slowdown. But obviously, if the labor pool continues to, if the labor market really does struggle, that's going to significantly impact demand, and that's going to, in turn, prolong the rent growth recovery that everybody's banking on.
And correct me if I'm wrong, but I think that the data is roughly 1 million new multifamily units came on the market between 24 and 25. Is that roughly accurate?
Yep.
And then to your point, pretty clear whatever data source you're looking at, that's going to fall off a precipitous cliff 26 into 27. So if you're the economist, I'm not, but the supply and demand I understand is that in and of itself should lead to rent growth based on demand. One of the factors that often I've heard you speak on your podcast and in other channels is that there is this perhaps misconception that I certainly sometimes fall into around the direct correlation of the for sale market with the rental. And so when I see the rate cuts, the first thing I hear of is all my friends here in the Tampa area across the country who want to sell their homes, and they're cheering this, saying, okay, great, I can afford something else. What does the data tell us as you look at the REITs, or in particular perhaps the SFR operators, if we do see, there's been a lot written of, there's this real dearth of supply, there's a backlog of people that want to get into the for sale market, and we've just been waiting for rate cuts to come. And I don't know if 3 cuts moves the needle, but what historically has the data or the correlation been or not been between an active for sale market and the rental housing industry?
Yeah, no, Tyler, I love this question. And just as a quick background, one of the things that really got me, when I first got into this industry, I had no intent of sticking around very long. And one of the things that really got me stuck on it is I love the myth busting element. There's so many things about rentals that I think people just assume, that I assume. And then when you just dive into the data, you realize some of these things aren't actually true. And so I look at the amount of credit that everybody's giving the stalled out homebuyer market for what's happening and the demand for apartments and single family rentals. I'll give you an analogy. Like, I think of it as, imagine you're on a football game where it's 20-20. At the fourth quarter, there's 2 seconds left, and a kicker kicks the game-winning field goal. The kicker's the hero. They're lifting him up, and he's the story. But you wouldn't have gotten there if you didn't have an offense that scored 20 points and a defense that only allowed 20 points. And yes, like the stalled out homebuyer market is a factor, and it's the thing. It's like the shiny object right now, but it is not the key driver. It is not the main driver of the market. And so to answer your question, I think that one of the reasons investors love multifamily and SFR is that we have a relatively high floor, and so you see a lot of volatility in the homebuyer market. In the rental market, when the economy is softer, even like right now, for instance, we're still seeing very high retention rates, and that's protecting occupancy. People aren't buying a house, so that's boosting highest retention rates we've seen on record. But that is not aligning with rent growth, as we just talked about. And historically, you look at the best years for rent growth in the market. Again, the high floor of the sector is what we see right now. But the high ceiling years were periods of high home sales activity. Over the last 15 years since the GFC, the best year for rent growth, which was 21, 22, those were also the best years for home buying in the last 15 years since the GFC, in almost 20 years. And so that's not a coincidence. And the same thing historically, we see when people are going out and buying homes, we see better rent growth for both SFR and for apartments. And I think what happens is, Tyler, I know you understand like the data is important. I think people latch on to one or two metrics. In reality, you're just picking the metric that matters at a given time. And so where I'm going with that is that if sometimes we think that higher retention means higher revenue growth. And that's not exactly what happens. Now, I think you want to protect your back door. You want to do well with your residents. Retention is important, especially in a slower demand market. But historically, when you have a high home sale market, people are leaving to buy homes. You have more move-outs to purchase. In that type of economy, people are likely going to Home Depot and Lowe's, hiring contractors. That has a downward impact on consumer spending and on job formation and household formation. And so in that type of environment, yes, you do lose more renters to home purchase. But in that environment, you're backfilling those units faster and often at a higher rent. And so you could see better overall revenue growth. And again, I think the good thing about our industry is you could do well in both of those environments. But the idea that we can do better in a weak home sale market has never been true. It wasn't true in the early 2010s. It certainly hasn't been. These last couple of years, we've seen very little rent growth, despite people not buying houses to a large degree. And I think ultimately, whenever I go to investor events, I tell people, I say, look, if you're in the rental housing business, you should be cheering for a stronger for-sale housing market. Because when the people are buying houses, that's a stronger economy, and rental housing will do better in that environment as well.
Oh, I love that. And the one pushback I'll give is that your former guest, Jesse Stein, and I are both kickers deserve all the credit. That's the only thing.
Oh, I didn't know you were too. Yeah.
Yeah, I did not play in college like Jesse. I played soccer in college, but yeah, no, kickers deserve all the credit. So on the theme of myth busting, to first an aside and then a question. One aside, another plug for Jay's podcast. On your most recent episode, you talked about the truthers out there on vacancy. And I think you just alluded to it a little bit, that revenue management, there is a need to have you need people moving in and out of apartments to grow rents at the end of the day. So separate topic, check out Jay's Rent Roll podcast to hear about the truthers. But a huge myth that I want to make sure that all of Funnel's multifamily impact listeners hear and understand. Because I think anybody who spent any amount of time in the rental housing industry, regardless of your political affiliation, comes to understand this myth, which is that rent control doesn't work. And so you and I were just in New York City, and a city that has long struggled with housing affordability. A beautiful city. I lived there for a short period of time. I love it. I hope someday to be able to live there again. But right now, speaking of headlines, there's a leading mayoral candidate in New York City who is going to take rent control to a whole new level. So maybe just at a macro level here, since we're on the theme of myth busting, maybe Jay, could you just lay out for our listeners what's being proposed, how it goes beyond what already is a city that has a history of rent control, and what outcomes do you think this might have on the New York City rental market?
Yeah, absolutely. And I agree. New York City is a wonderful city and a great place to live if you make a lot of money. And unfortunately, not a great place to live if you don't, in large part due to the policies they've had in place for 100 years. And so just to give you some context, New York City has had various versions and various flavors of rent control going back 100 years. And what is really ironic is that despite all of this time, New York City is still the most expensive market in the country. It's still a hot button topic, obviously, in the mayoral race there. And so the natural reaction is not, hey, let's go look at the research. Let's go trust the science. Like what we see in the arguments around vaccines. Let's trust the science. No, it's, hey, let's double down on what hasn't worked for 100 years. Let's do more of that. And so what the leading mayoral candidate, Mamdani, has proposed is a rent freeze on specifically rent-stabilized apartments. About half of New York City's 2 million apartments are in the rent stabilization program. Now, that segment of the market is not one that's going to affect a large number of institutional investors. It's very much a mom and pop market. And I won't get too much in the details of this, it's been significantly impacted since a 2019 law that enacted vacancy control. And what that vacancy control is a more extreme version of rent control, where it's not just your rent control is not just on the renewal, but also on the new lease. And so we've seen values of these properties fall, in some cases, 40, 50%. That change almost took down a major bank in New York City that was heavily exposed to the rent-stabilized apartment market. So what happens ultimately is these buildings become time capsules because there's no money to invest to properly maintain them. And so you have various reports of units that sit vacant because the owner can't afford to renovate it to a degree to pass code to rent it out to somebody else. And that's not good for anybody. And so there's some real horror stories, unfortunately. And then what we see now is a desire to double down on the same policy despite the challenges that are in that market. And so turning affordable housing into time capsules is not in the best interest of renters. We need to do more. And I'd also say, too, is if we really want to, if you really care about people in need, what is less compassionate than selling them something that's proven not to work? Like, I think that's very non-compassionate. It's not showing that you care. It's not showing that you're serious. Let's focus on what's actually proven to work. It's to build more housing and also put your money where your mouth is. Like, again, if you want to be compassionate, you show you care by putting your resources in to solve the problem. Instead, what they propose there is to have small mom-and-pop landlords shoulder the problem. And it's an unfortunate situation. You'd like to see more focus on what's proven to work, which is supply. I tell people all the time, it's the one thing that policymakers, analysts, researchers, the industry, and housing advocates all agree on. Hey, we need more housing. And I think and people will say the same thing. They'll say, hey, well, yeah, we need to do that too. But the issue is that when you tell people when you put so much energy around other things that are proven not to work, it takes energy and it takes urgency away from really solving the problem through supply. And New York City is in a tough spot, and while it doesn't affect a lot of institutional investors, I do think that there's concern that eventually you'll see more crackdown on, or more regulation, even on the higher end institutional luxury Class A market as well.
Yeah, well said, Jay. I really appreciate that. And I think that, again, those of us who do believe that we stuck in this housing industry because it's a wonderful industry and we're serving homes to Americans, I think that we all are on the side of let's use what's working. I think one thing as an industry, and I love the nuance you bring to the conversation, is that more than ever in my adult life, we have evidence that supply works, right? You just look at the markets, you look at the data that you're consistently putting on LinkedIn, places like Tampa, Florida, and Texas, where you live, and Salt Lake City, where my dad invests in apartments, places that for the years where there was a lot of development, we just talked about the 1 million apartment units that came on the market, rent growth has stalled. And I think as an industry, you look at that and certainly say, hey, we want to get back to rent growth. And I think that's great. Is that capitalist incentive is what drives people to want to put more capital work and build more housing. So there's nothing wrong with that. But I think sometimes we forget to really highlight how well it has worked in areas with massive demand. I just referenced Utah, Texas, Florida. Hundreds of thousands of Americans, millions of Americans have moved to those states in the last 4 years. But rents aren't growing. So demand is massive, but because the supply was massive, we figured it out. So anyway,
you're right. And Charlie, one of my kind of pet peeves in this topic is that the haters on this topic, what they'll say is they don't understand the demand. And let's take Austin, Texas. Austin's been the worst market for rents in the country among major markets. And what you'll see these stories saying, oh, everybody moved to Austin is now moving back to California because they realize Austin's too hot, right? And that's crazy. The demand numbers, it's not 21 anymore, but these demand numbers are still really good in all the places you mentioned, in Texas, in Florida, in Utah, in Arizona, in Tennessee, in the Carolinas. That's where the people are going. That's where we see the most demand. And yet rents are falling in most of these spots of these last year and a half, 2 years because of supply. And whenever I give a presentation, I have a chart that I show that's one of my favorite charts, and it shows the relationship between rents and supply. And you can draw a line where it's like the more supply, the less rents. And the places where rents are growing, there's no supply. And so it's just not that complicated. I think everyone on the cynic side, they want to find every reason except for the actual reason to explain why the market's doing what it's doing.
Yeah, and I appreciate the work that you're doing. And I think that as an industry, we're evolving and getting better at that dialogue. Well, one more topic on that I'm going to correlate with supply is that recently in the news, we have seen a couple of essentially developer subsidiaries exit the multifamily business in different ways. So the first one that I don't have in my notes, but I'm adding to the list is Quarterra, right? Quarterra is a subsidiary of Lennar, and Lennar, as most people know, is a leading home builder in the country. I started my career in home building. Lennar is the big name, or one of the big names in home building. And they used to have LMC. LMC got rebranded to Quarterra. Recently in the news, Quarterra was acquired by Alfred, which is a prop tech vertically integrated company, client of Funnel. We just had Jess on the podcast. They're great. But they gave over the management to Alfred, right? And they're merging that with RKW, more traditional manager relationship. More recently in the news, we heard Toll Brothers is effectively exiting multifamily development. So
Yep.
does this go back to maybe what you and I were discussing? These are two organizations that do development. They both also have for sale development. It seems to me maybe this is more evidence of what you were discussing earlier, that when home sales are down, rentals are down, and therefore those companies are retrenching into their kind of core business. That what we think is happening here?
Absolutely. I think that I don't want to put words in anybody's mouth, but I think if you put a truth serum in some of these groups, they would tell you that there's fewer synergies between home building and apartment building than they probably thought when they started doing this. They're very different businesses. You're building very different types of product. You're probably using different subcontractors and trades. So there's in different materials. Like it's just, there's not a lot of overlap other than the fact that you're building housing, which we need all of it, by the way. And the other thing, too, that Toll Brothers talked about when their press release, and I think is a really good point, is that for home builders, they're typically building homes that are $400,000 or $500,000, and they can sell them to fairly quickly. Not as fast as they sometimes want, but it's fairly quick. An apartment building, these are $100+ million projects with a comparably finite number of potential buyers and a lot of variables on the exit strategy. And in effect, what that means is they could have $100+ million of value locked in with a uncertain exit period, and that's a lot for them to carry on their balance sheets. That impacts their earnings calls and being publicly traded. They got to explain this property didn't sell until now. It's going to be Q4 instead of Q3. I think it's just a lot of that kind of stuff. That's one apartment property is, what is that, 200 homes or something. And so it moves the needle a lot more, and there's a lot more variables for them. And I think all of those things factor into it, and again, allows them to focus on their core business better. And we still have some home builders still in the market, but again, it's just different.
Yeah, radically different. As I mentioned, I first came into the housing industry coming out of college. I worked for a builder in Salt Lake City, Utah called Ivory Homes. And one of the things I always tell my people here was just how different that is. And the mechanics, as you just articulated, are wildly different in that as a home builder, scarcity is both your biggest enemy and your biggest asset, that there's only so many new builds you can do. In the rental industry, it's cyclical, to your point. And then both the community itself, the rents themselves. So I can imagine as a large public organization that those are just really different motions, one from the other.
Oh, and you got to operate the thing, right? You got to run a building. That's hard.
You can't just distribution. That's right. It's a very different thing. And I guess that, frankly, to your point, that vertically integrated operating model, very different motion from just asset manager to property manager, which I think what we're seeing with Corterra, for instance, is they're still doing the asset management side of those multifamily, but the property management they've handed over. All right, a different topic. There's a lot has been written about the topic of fee transparency. Another plug for your podcast. You had Joanna Zabriskie of BH on the podcast talking about this topic. We were just talking about single family versus multifamily. The BH organization was acquired by Pretium. BH not only manages multifamily, but perhaps what folks aren't aware of is that the BTR, these built similarly but managed like multifamily communities, fall under BH. One of the things Joanna brought up about fee transparency as it's going to affect states like Massachusetts now is that it's really messy. It's really messy because the rules of engagement have not been set. They're being kind of litigated market by market. When you look at perhaps from a data perspective, the impact this may or may not have. I think there's a perception that the big corporate landlords are making a ton of money on these fees, and we're going to cut out all those fees. I think the perception I hear from our customers is that we think the vast majority, if not all of these fees, are value add. We're keeping them. And now we just have to figure out how to be more transparent, or more, in some cases, cover our butts legally to make sure they're on the docket. But any thoughts in terms of the transition that we're going through as an industry, ancillary revenue being baked in to now being really marketed, that ancillary revenue? What are you hearing from operators and asset managers in that transition?
I think, Ty, you hit a key point. I think first and foremost is there needs to be clarity around the rules. And that, I think, is really frustrating and ultimately very anti-business and anti-innovation when the rules are a moving target. And when it's like, hey, we're talking about things like around fees that have been in place for 20, 30 plus years. It's all of a sudden, oh, wait a minute, like this shouldn't be happening. Now there's a lawsuit being filed. That's not, at the end of the day, this is not good for anybody. It's not good for our economy. It's not good for job creation, innovations. There needs to be clarity around, hey, just tell us what the rules are. The tone around this has gotten so destructive. You and I notice a lot of the same people. It's like, no one's trying to break rules. Like there's confusion around what the rules are. And so I think that part is very disheartening. And it's happening, by the way, both kind of red and blue places. It's not like it's one side. It's very unfortunate. And then the other part of your question is where we're going. I do think that, I mean, look, because as a consumer, I don't like paying nickel and dime fees. Like, none of us like that. And so I think this could be a positive shift to all-in pricing. And the problem I think you're into, and Joanna talked about this on my podcast, is that our properties are listed on an internet listing site, and your rent, if you're all-in pricing, is going to be higher than somebody else's who's not including their fees, even if your property is otherwise directly comparable. And so that makes you look like you're more expensive. So a renter had to actually go in and realize, oh, hey, wait a minute, BH is including those fees, the other one's not. And so that actually is, maybe I'd rather do that. It's all in, it's probably a similar price. And so that is a big thing has to change. I think people want to see more kind of wide adoption, so everybody gets more comfortable that it could be done without pushing out future or turning away demand that's pushed out by the price. And the last thing I'll say, Tyler, I think is where we're going. I think that it's the ancillary revenue, and this is just me speaking. I think it has to be probably going in a direction where it's true add-on services that a resident is willing to pay for additionally, as opposed to mandatory things. And whether it's covered parking space or booking workspace in the leasing office, all that type of stuff, and then less of these kind of vague, particularly, not everybody does this, but we did have some cases we have like generic amenity fees, things like that. That's the stuff that is not going to be popular with your residents or with your local municipalities.
Yeah, maybe let me take this a little bit off script, because I think that I agree with the thesis on, I know the executives at the organizations, Joanna came on your podcast, but Funnel gets to work for the largest managers, largest REITs. These are good people who care about providing quality housing and are not trying to nickel and dime. And I agree, though, that as an industry, and this is no different than what Airbnb's gone through, what just about every vertical goes through of the airline industry, of consumers, we as consumers have a breaking point where you just feel like you're not getting enough value back. And certainly as somebody who lives in Florida, if you come to a hotel in Florida, you feel it because Florida does this. We don't have income tax. We have a very high tax on hotels. And so you go to check out of your hotel room and that $300 a night hotel is $450. And so we all hate getting those extra costs. So I think directionally, I agree that we need to have better transparency and make sure consumers know what they're paying for. I think that will end up being a healthier ecosystem. But you said something, and I heard something similar this week at the Pretium Symposium. We were talking about AI and AI rules with Palantir and Elise AI and Funnel. Revenue management obviously has been a hot topic in the industry. I think every business operator, be it technologists thinking about AI, multifamily operators thinking about revenue management or fee transparency, they just want to know the rules of the road. However, I do think, as somebody who enjoys studying American history, states have a right to make their own laws. And I wonder, we've moved towards, the data shows, you and I have talked a lot with different operators who recognize that the future are larger operators. Don Beveridge in particular has talked about this. The NMHC Top 50 is becoming more consolidated. Fee managers are getting bigger. The REITs have
among managers, not owners, by the way, but yeah.
That's right. I was going to say, the managers are getting bigger. The REITs are about the same size they were. If most operators of the kind of conventional multifamily side that you and I interact with are multi-state, is there a world in which, does NMHC need to be more out front coming up with the fee transparency rule? I know we've tried that. NAA. How do we get away from the patchwork of fee transparency rules and revenue management rules? Or is it just the cost of doing business in a multi-state approach?
Yeah, and you're right. It's not even multi-state, it's multi-municipality. The rules can be very different based on an invisible line between cities that you don't even know you're crossing over into sometimes. And that makes it very difficult. And I don't think people realize, I posted on this on X recently, and I got a kind of predictable reaction. I was saying, hey, like when you pass these little laws, Berkeley, California, there's a law there that because of the vacancy truthers you hinted at, like the apartment owners have to file a vacancy report showing any unit that's been vacant more than 6 months, there's a vacancy tax on it. And so these bozos out there, we're going to generate tax revenue because these people are holding their units vacant. And they don't realize that a vacant unit, like they think there's some sort of magical tax benefit for a vacant unit. There's not. A vacant unit is lost revenue. You make no money off a vacant unit. So anyway, like lo and behold, what happens? After 2 years, they've generated zero of income from this fee. So anyway, back to your point. I wrote a little tweet. I just said, look, like people don't realize like that this little, what seems like a little thing is a major compliance issue for an apartment operator, because now all these things that differ across these different cities and different states, that's built up compliance. All your big clients, Tyler, they all have compliance departments, and these things. It's not like your leasing agent's going to fill out this vacancy report and submit it and just be done. No, there's a lot of teeth in those reports. They're very detailed, and if you screw it up, you're going to get sued. And so and all these things add up. And I think it does, again, favor larger firms, have the resources to have compliance teams that can handle all this stuff. It's just, compliance is a major, it used to be something you only dealt with in affordable housing. Now it's all across the board.
Yeah, that is well said. And I think what you just articulated reminds me of the conversations around why is it so expensive to build in America? And it is the patchwork of legislation, the compliance, the bureaucracy, the red tape that just makes a lot of deals not pencil, especially right now. And unfortunately, then you need crazy rent growth just to justify the dev work. I think similarly, unfortunately, we're moving right now towards a world into there are just too many layers. And I think you're right. I think we'll continue to see more of the large operators. One of the questions I want to follow up with on kind of the last two questions you've alluded to in different ways. A, nobody wants a vacant unit for long. That's a perishable asset we're losing money on. Talked about previously that retention has continued to tick up. So you've alluded to this on your podcast and in different posts. What are some of the factors that you think, you already said that one of them is certainly that buying homes is harder than ever. So that absolutely contributes to retention. You've alluded to other factors and just maybe perhaps the improvement, the maturation of the experience of professionally managed apartments. So maybe unpack that a little bit of why we are seeing, and in particular, you mentioned with fee transparency, not only is it good for an operator to not have to turn a unit and keep somebody in, but usually there may be a rent increase. And then often many of those residents who stay longer, our data shows they're the ones who are more likely to buy the ancillary revenue fees. That they want the extra parking spot, or they want the gym pass, or whatever things may be available to them. So what are some of the other factors that may be contributing to this kind of more, the lengthening of the customer lifetime value in multifamily?
Yeah, no, I love this topic because, again, going back to our Mythbusters stuff, we started off talking about home sales. And I posted a while back this chart that John Burns' team put together, and it shows the 7 major REITs and their turnover stats over the last 10 years. And so if you just think the public narrative, you would have expected to see, okay, pretty flat, move around a little bit, COVID, and then all of a sudden mortgage rates go up and then turnover goes way down. But that wasn't the case at all. It's actually been a very clean trend line down for the last 10 years. And so I think that we have to be a little more intellectually curious than trying to give the homebuyer market, again, all the credit. And by the way, just going back to that for a second, I think because most of us, even in the industry, because of function of we're getting older, we're a lot of us are homeowners with kids, we sometimes are still guilty of just seeing our own industry through the lens of a homeowner. In reality, there's a lot of other factors at play. And so what could be impacting a 10-year trend line, not just since COVID, not just since home prices went up? And I think there's a lot of the things go into it. I'll say number one, you look at when I got out of college in the early 2000s, 2004, I graduated, even that era, it was just starting to change, but you lived in an apartment because you had to for a period of time until you get out. Like when the first day I moved in my apartment, I was ready to move out. Like it was fine, but it wasn't a highly amenitized, great place to be. It was next to an IKEA parking lot. You couldn't walk anywhere. The gym was just one of those like Nordic track things. There's nothing to it, right? Now, like you look at what's been built over these last 15, 20 years, they're really nice buildings in great locations. And I think that matters. They're more attractive places. You may have seen this, Tyler. There's a good article in the Wall Street Journal a few months back. It was about Gen Z renters and what they're looking for. And they're talking about things like the aura of my building is so great. We never thought about aura. I don't know about you, but I certainly never thought about the aura of the building, the energy of the building. But they're being built really well. And then secondly, I think, Tyler, to your credit and to the credit of the industry at large, it's a mixture of technology and people. Like the people are getting better. 20 years ago, remember, all the property managers were generalists. They all had 1,000 jobs to do, from like bill keeping and invoicing and then leasing units and taking care of residents. Now they're getting more specialized. So the people who are dealing with residents are generally better at that than they were 10, 20 years ago. And they also have better tools. The technology around automation, centralization, AI, being able to do certain tasks off-site to let the people on-site really focus on what they do well, being the people, and let the back office people be the back office people. All of those things, it's just logically, I think sometimes you'll just too dismissive as, yeah. But no, just think about it. If you really make a sincere effort to do something better, which in this case is to better manage your properties, and there's better data, real-time information, technology, all these things, a report a maintenance ticket on your phone, like I used to dread having to go walk in a leasing office to deal with anything. I don't have to do that anymore. All of these things, I think, create a better living experience. And if you're happy, you're more likely to renew. And I'll say one last thing, then I'll stop because I've been ranting for a little bit here. Is I tell people all the time, look, like, just because someone can't buy a house does not mean they're going to renew with you. They have options. If they want to remain a renter, they have plenty of options to rent at all price points and in most markets. And so if they're renewing with you, it's probably because you're doing something right. And if you're not doing something right, they're going to move out. And so the fact that turnover is what it is, it reflects a lot more than just home purchases.
I love that. You couldn't be more right that I think the industry in general, through a combination of technology and people, have gotten better at it. And I've had, in my renting experience, I've seen that. I also just want to say, everything you advocated for, I think one of the reasons I also love this industry, and I'm so pro multifamily, pro the capitalism that makes it run, is if you go to another country and you look at what renting is in other countries, it's miserable. It is not the quality that you see in the way multifamily works, and both the supply that's being built into multifamily and the quality of really phenomenal business operators with the ambition to earn the right to have that renewal is a wonderful thing. It's a wonderful incentive and mechanism. I was going to end on that because you hit so many good points, but I was too tempted. I've got one more question for you. You just talked about the reasons to move out. And one of the things I've picked up on, I know the data supports this, but man, anecdotally, I see it. I spend a lot of time secret shopping. I drive past a community and I get to a red light I immediately type in the name of the community and say, oh, who's managing this? What technology are they using? And man, Jay, everybody's got a little splash page that pops up on their websites now that says 6 months free or some ludicrous amount of concessions. And I can't believe it, because I worked at LRO back in the day. I thought we had disavowed this notion that concessions were a good pricing strategy. So what's going on with concessions and why are they in vogue and everywhere?
Yeah, no, the concessions we're seeing. So you have lease ups that are offering 2-3 month concessions. And then that normalizes like an expectation that, okay, if I'm a Class A operator, now I got to offer concession. People just need to see a number saying, oh, something's free. And that goes on down market as well. And I think you're right, Tyler. I think this has also come up a lot in the public policy stuff of late. And ironically, I think it was in New York, you hear these, again, you can't win. You have one side that says, hey, if you're not offering concessions, you're just trying to rip people off. It's, no, I just say, hey, let's just cut their rents to what actually the number should be. Because at the end of the day, that means their rent's going to balloon at the end of the term. And it also gives the apartment owner unrealistic expectations of what their value really is. Because are you really going to burn off a 2-3 month concession in 12 months? Probably not. But you're not going to raise someone's rents 24% effectively in a 1 year period of time for the most part. That's just not going to happen. But there's a case, I think it was in New York City or somewhere, where there's actually a lawsuit because someone called concessions deceptive pricing. And so again, you just can't win with this stuff. So at the end of the day, I think renters are smarter than we give them credit for. They just want a good deal. It doesn't matter how you get it to them, get them a good deal. And I think that it's ultimately in everyone's best interest to have bottom line pricing. But yeah, concessions are more abundantly available. But my biggest thing I would tell you is just do not bake your assumptions off the thinking that you're just going to burn that concession off next year, because it's probably not going to happen.
Jay, this has been phenomenally fascinating. We could do this for a couple more hours, but thank you for your time today. Look forward to continuing to have the conversations with you, and thank you so much.
Yeah, thanks, Tyler.
Thanks for tuning in. If this episode got you thinking, here's the next step. Join us at the Forum, the best conference in multifamily, March 23rd to 26th at the JW Marriott Camelback Inn in Scottsdale. I can assure you Forum is not the average conference. It's built for multifamily executives who are rethinking how teams, technology, and operations come together to deliver standout renter and team experiences. If that sounds like you, this is where you need to be. Registration's open now at the link in the show notes. Early bird pricing runs through November 2nd, and a heads up, Forum sells out every year. Don't wait. Grab your seat at the best rate today. We'll see you in Scottsdale.